Good evening, and thank you for joining us today to discuss on the topic market volatility. Can Robo-Advisor help? On behalf of the team at MYTHEO, we would like to welcome you to the webinar. My name is Simon, and I'm the Chief Business Officer at MYTHEO. Before we start, for those who are not familiar with MYTHEO, MYTHEO is an innovative digital investment manager that utilizes investment algorithm to manage and automate your investment portfolio. By leveraging on human technology and artificial intelligence, we are able to offer you a highly personalized and diversified investment portfolio that conforms to your specific needs and investment goals. Since our launch in 2019, we have helped many investors improve their investment returns, and most importantly, giving them the peace of mind to enjoy their moments in life. A quick rundown of today's webinar. It's going to be a 1-hour session, and we'll carry out it in Q&A format with some live polls in between. So we will be looking forward to your participation. And if, let's say, at any time during the webinar, you would like to ask the speaker any question, we encourage you to interact with us via the Q&A button. This webinar will be recorded. You can play back the recording from the link which we will share to you via our key takeaways email tomorrow. I'm joined by Matthew Stuart-Box, the Chief Investment Officer of MYTHEO, where he is responsible for the development of all investment algorithms, portfolio management, and trading at MYTHEO. Besides that, he's also the Chief Operating Officer of our parent company, Theo Japan, where he is responsible for all the investment platform related teams, including portfolio management, trading, and operation. Before we start, if I may put up the first poll and ask a question to you. Okay. You can see from your screen, what is your equity at market exposure as a percentage of total portfolio holding? Okay, great. Okay, let me share the result. Right, seems like no one hold more than 80% exposure into the equity market, which is a good news to a certain extent. So, so most of us here hold about 60 to 80%, which is quite sizable in our portfolio. So, so let's start our session. Okay. So so Matt, a question to you. Perhaps it's already close to half point of the year, right? So can you share with us how the equity markets have been performing so far?
Yeah, sure. Thank you, Simon. Yeah, let me just bring up some slides and. Okay, here we go. Yeah, so this is well, I'll start with equities and then move to some other asset classes as well, I think. But this is a table showing equity performance year to date in the local currencies for a range of markets around the world. And there's a couple of things you can see from here. Almost all of the markets are negative. In this table, there's only one market that we're monitoring that's positive, the Indonesian stock market. Almost all markets are down to some extent this year. If you look at a representative global equity index, like the MSCI All Country Index, that's down, as of yesterday, it was down 21% year to date. Within that, you can see on the left-hand side over here, the US S&P 500, so US large cap stocks are down about the same, 21%. NASDAQ, so the growth stocks in the US, large cap growth stocks, a lot of tech stocks in here, down even more, down 30%. But some of the other markets, things like Brazil, down a little less. Europe on the right-hand side is very similar to the US, down around 15 to 20%. Obviously, the exception is the Russian stock market. And then in the middle, you can see Asia Pacific, which has fared slightly better, perhaps, than the US and Europe. But there's still quite a range here. Shanghai is down 15%, Taiwan down 12%, Singapore almost flat. So you can see, it's been a rough period for global equities, really from the start of the year. If we look at some other asset classes, for example, interest rates. So this is a table showing global interest rates. So across the top, we've got various different currencies, the US dollar, Canadian dollar, sterling, and so on. And down the vertical axis, we've got the time period of the interest rates. And so maybe the one to focus on for this discussion is the US one. And if you think of, at the start of the year, US interest rates were, for the most part, around 1%. Now almost all, for all periods, above 3%, up to about 3.5%. And so that's a big move in interest rates for a market like the US. What does that mean in terms of bond prices? Well, say 20-year US Treasuries, long-term US Treasuries, as a result of the interest rate going up to 3.5%, US Treasuries are down about 24% year to date. So some big moves in the bond market as well. And then obviously linked to this is big moves in the currency markets. And so this is a matrix, again, year to date, showing the movements of various currency pairs. And obviously the one to focus on is the one on the left here, the US dollar. And so every major currency has depreciated against the US dollar year to date. Obviously it varies a little bit. The yen is down the most, down nearly 15%, but pretty much every currency is down against the dollar. And obviously that's part of that is due to the rise in US long-term interest rates. So some relatively big movements in the currency markets, but also obviously commodities. And here it's kind of like the flip side to the equity market. The majority of commodities are positive year to date. Obviously the standout ones are energy related. So here we can see in the middle things like natural gas, gasoline, crude oil, up 50, nearly 100% in some cases year to date. Also surprisingly, coal, that doesn't get as much mention, but obviously as an energy source, coal is up over 100% year to date. And a lot of agricultural commodities. Obviously wheat has got perhaps the most headlines, but a range of agricultural commodities, foodstuffs are up, 20, nearly 30% year to date. So we've seen some big moves, year to date, driven by a load of different factors. And maybe we can talk a little bit about what's been driving them a bit later.
Yeah, thanks for sharing that, Matt. So from the first poll, we know that more than 60%, in fact, of our participants who answered the poll has at least 40% exposure in equities, right? So I think this is a subject that I think we want to dwell deeper. The slides that you share on the equity pretty much is a sea of red, except for Jakarta, right? So last year, I remember it was a sea of greens. So this year is really exceptional. So is it normal to see such a volatility in the equity markets?
Yeah, I mean, that's a very good question. And I think, a lot of people feel that what's going on in especially the equity market right now is something exceptional or something completely out of the ordinary.
Yeah.
And the truth is, it's not. Equity markets are volatile. And if we look perhaps a little bit more history, it might put it into a little bit of perspective, perhaps, the kind of volatility that we're seeing at the moment. And so this graph here on the left-hand side, it's showing the long run history going back to the 1980s of global equity markets. And so here I'm using the MSCI All Countries Index. So this includes developed markets, emerging markets as well. So it's a very broad index. And you can see from this a couple of things. One, it does tend to rise over the long term. But you can see here, that there are periods of material downturns in equity markets. Here you can see this is the IT bubble peaking at the end of 1999, and equity markets in some cases falling by 50% in the 2 years after that. Here you can see this is the Lehman shock, and it's in 2008. Again, equity markets falling roughly 50% in the period after that. But in each case recovering. And from here you can see post-Lehman, this very long bull market in global equities with some ups and downs along the way. Here, this is the start of the corona pandemic in the first quarter of 2020. But as you can see, there's a long period of the bull market in global equities, and this is the most recent pullback here. So year to date, roughly 20% pullback in global equities. And so when we look at it on a kind of a longer term horizon, the movements we've seen so far this year are certainly not exceptional. A different way of looking at it is on the right hand side here, where this is exactly the same data, but I've just shown the yearly returns of the index. Starting back here in 1988 and going through here to year to date in 2020. And so you can see, there's a lot of variation. It's positive most of the time. The average return of global equities in the long run is perhaps 8%, maybe 8.5% in the long run. But there's a big variation year by year. Where we can see years where, it's up over 20%. Sometimes even over 30% on the year. But yes, when it's bad, it can be 10, 20, in some cases here, over 40%. This is Lehman here, over 40% down in any one year. And so from this kind of context, looking at 20% down year to date is certainly a large fall. Certainly given the strong returns we've seen over the last 2 or 3 years. But it's certainly not exceptional. There's nothing out of the ordinary in that sense.
Yeah, thanks for sharing this, Matt. It does seem that it has happened a lot of time in the past, where we have a magnitude of more than 10% kind of drop, and even more than 20% as well. But over long term, we do see that the equity market, we do see that the equity market has actually generated positive returns. And I'm sure most of our audience here would remember vividly the last time equity market dropped by more than 20% during the COVID-19 pandemic. Right? It was mainly driven by the lockdown of the economy. So, so this time around, right? Perhaps, if you can help us to understand or refresh our memory, that what have been the main driver or main forces behind the negative and also the volatile market that we have been experiencing so far this year?
Yeah, sure. So the kind of underlying drivers of the fall so far this year are pretty well known, and we've talked about them a few times on these webinars. And it's a combination of factors, but the core underneath it is inflation, the return of inflation. Originally in the US, but also in many other markets as well, in Europe, developing markets as well. This is something which has been inflation has been very quiet for a long time, basically since the Lehman shock, and we suddenly had a resurgence in inflation, driven by a range of different factors. Some to do with the pandemic, in terms of supply chain shocks, things like that, some driven by the rise in energy prices, partly due to an imbalance in the oil market, and obviously more recently due to supply problems as a result of the situation in Ukraine. On top of that, strong wage growth, particularly in the US, have driven inflation to levels that we haven't seen for 20, 30 years. That obviously gets both equity investors and fixed income bond investors worried, because it's linked to higher interest rates. The central banks, their main tool for dealing with inflation is raising interest rates. And we've seen the Fed already start to raise interest rates. We have another Fed meeting very soon. Perhaps they'll raise some more. A lot of those are already priced in, but that's certainly been a driver of returns for the equity market and the bond market. On top of that, there's some other more recent concerns. I know many investors have been concerned about the outlook for the Chinese economy, partly as a result of the very strict lockdowns in China, this kind of zero tolerance policy, but also more generally, a feeling that perhaps this long period of very strong, very stable Chinese GDP growth may be coming to an end. And that's been such a consistent backdrop for the global economy for multiple years that it's very disconcerting when people start to think, well, perhaps that could be drawing to a close. And then on top of that, you overlay things like the lingering concerns on the pandemic and geopolitical risks that we think that we used to think had gone. And you get a lot of things that people start to worry about. And I think that links through to volatility, a range of different things that people have not had to think about. Haven't had to worry about inflation for a long time, haven't had to worry about geopolitical risk for a long time. And suddenly there's a back on the agenda. And I think a lot of investors are struggling in how to price those kind of risks. Right.
So, I think the main factor that you mentioned, inflation, Chinese economy, and also the geopolitics, certainly something that we have not been witnessing during the last bear market, right? Or the last market volatility. So this time around, it's totally different drivers. So the inflation, right, I think this is the things that people basically closely watching for. In fact, the Federal Reserve is having their meeting tonight to decide on the rate hike. So so we realize that inflation number, the recent number, has been higher than at 8.6% versus 8.3 last month, versus 8.3 the previous month. So basically, it has exceeded, right, in investors or analysts' expectation. And you have mentioned that reason that inflation is so high is because of the supply chain shock, as well as the high oil price and also the reopening of the economy. So the most, I think, important question for us is, in your opinion, do you think that this high inflation level that we're seeing today could actually help to spark a recession?
Yes, that's a very good question. If we think about it, perhaps from the US point of view first, we have to be clear. People are worried about higher interest rates, but very few people, as of right now, are predicting a full US recession. The US economy, as of right now, is very, very strong, both in terms of GDP growth, wage growth, employment, and earnings growth, company earnings growth. We've just been through a US earnings season, which has been ahead of analyst expectations.
Right.
And so, I think so long as the US economy remains in this kind of state, it's more than capable of taking the interest rate hikes that the Fed is currently considering.
Right.
Obviously, the big question is whether the Fed will exceed expectations and raise faster, or raise to a larger extent than's already priced in in the market. And that's something we simply do not know. Having said that, the Fed has been very clear that they will be driven by the data. And so my expectation is that, they won't be swayed by a single data point. The fact that, an inflation number has been higher than analyst expectations. I wouldn't say that's not likely to be significant in their decision. But obviously, they get to see a lot of very granular data from the regional Fed boards about how the economies are working in each of the regions in the US. And if they get the feeling that the economy is growing even faster than we're aware of, then it is possible that they could raise faster than the market's expecting.
Sure. So far what we have seen, Fed has been pretty laggard, especially last year. But we never know, right? I mean, they could actually sort of playing some catch up there. So, but anyway, market has reacted badly. On Monday, the US S&P 500 index has fallen, I think, year to date by more than 20% of its peak. So is US market in a bear market now? And how much worse could the market get?
Yeah. I'm sorry, I've just seen some messages that it's a little hard to see the slide. So could you just give me 1 second? Let's try and rectify that, because
Sure.
I wouldn't want to. Okay. Okay, perhaps that's better. Right. Okay, so so normally a bear market is thought of as a fall of over 20% in the equity market, and so in that sense, technically we are in a bear market in the US. I think some people are surprised that it hasn't, the market in the US hasn't fallen more, and I think perhaps the reasons there is, as I said, the fact that the underlying US economy remains strong. Corporate earnings growth remains strong. So corporates, American companies are, so far at least, have been able to pass on the increases in costs to the consumers. And so they've been able to maintain their profit margins. So from that point of view, that's a very good support for equity prices. But I also think there's still an element of perhaps complacency among equity investors. As I showed you earlier, we've had such a long bull market since Lehman, stretching way over 10 years. Obviously, there's been ups and downs along the way, but it's been a very strong period of equity returns for 10 plus years, on the back of support by central banks. And I think there is an element of a feeling that, if things get really bad, then the Fed will step in and help bail things out. And that might be the case, it might not be the case, but I think that there's an element of that kind of complacency in the market. I think it is useful to look, I think, about what bear markets tend to look like in terms of in the past. And so this is a very, very useful graph from a research company that shows all of the bear markets in the US since World War II. And you've got what 10, 12, 15 or so bear markets, and you can see the fall of the S&P in each of those bear markets. So on average, they fall just under 30%. So if you say, as you said, year to date, we're down just over 20%. So we're in the kind of normal kind of range of a bear market. And then they show here on the far right-hand side, the number of months, the length of the bear market. And the way they measure this is from the peak to the trough of the bear market.
Mm.
The number of months that it takes to fall from the most recent peak to the bottom of the bear market.
Yep.
And so you can see there's a lot of variation. Some are very short, only 1.5 to 3 months, very short, sharp bear markets. So we saw the one right at the bottom there, the one in 2020. That's the one at the start of the pandemic, a very, very sharp, down 34%, but only took just over 1 month to fall from the peak to the trough. Whereas some of them are much more drawn out. You can see some of these that are well over a year, 20 months. I think the longest on here is 30 months. That's the post-IT bubble. So there's a lot of variation. On average, just under a year from peak to trough. So if you think, we're halfway through the year and we're down 21%, if things turn out to be an average bear market, then we could see, perhaps another 10% fall spread over the rest of the year, something like that. That would certainly be a potential outcome.
Sure. So perhaps based on the historical data, there's still further room to go from here. Also, it's perhaps it's a good time to ask our audience this question. So if you can see from the screen, is now a good time to invest? Okay. Thanks for the participation. Let me share the result. Wow.
Oh, that's nice.
More than 70% of our participant thinks that now is a good time. Yes, it's a good time to invest. Okay. So the inevitable question, Matt, is what do you think? Is it now a good time to invest?
Well, I'm glad that people are quite positive about investing. My personal view is, and I've said this before, there's almost never a bad time to invest. From the point of view of, in the long run, asset prices do tend to rise. It's very difficult to predict when they're going to rise, but they do rise. And so being out of the market, not investing, has, in the long run, a big opportunity cost. And so I think in general, you're better off being in the market rather than trying to time in particular rebounds. One way of looking at it is maybe in this next slide is it looks at kind of what happens after bear markets, and I think this is very useful. This is a great chart that's used by Invesco a while ago, and really it's showing very similar data to the previous page. This is also the S&P, so this is also US, and what it's showing is these red marks here are the bear markets. So it doesn't go back quite as far as the previous slide, but these are the bear markets in the past. And you can see each one is 27, 28%, 22%, 36%, and so on. And then the green part is the recovery after the bear market. And there's a couple of things that kind of really jump out from looking at it this way. Is obviously the length of the recovery periods is much bigger than the length of the bear markets. Bear markets, they're an exception, and they don't tend to last that long in the big scheme of things. There's much more periods where the market is rising rather than bear markets. So that's the first point. And then the second point is look at the scale here. this shows the scale of the recovery relative to the bear markets. And so each of these bear markets, by definition, is more than a 20% fall. But look at the recoveries afterwards, 86%, 80%, 48%, in some cases well over 100%, here 200%, 580%, these kind of recoveries. And so what this is showing is like, although, it's very disconcerting to see, your assets fall by, say, 20%, 30%. The scale of the recovery post a bear market way exceeds the amount of the drawdown in the bear market. So unless you're confident that you can time these small red periods, get in and out of the market to avoid these red periods, you're much better off staying in the market for the whole period and picking up the whole of the recovery. So, this is just another way of saying that timing the market is a very difficult thing to do. And the opportunity cost, the potential opportunity cost of being out of the market when the market does recover can be very painful.
Yeah. Well, good point. Well, this chart definitely has shown that the scale of the bear market is rather small versus the bull market, and probably the pain is much shorter as well for us that invested in equity market. So we should be able to enjoy a longer good times in that case. So just think from a good positive perspective that. So well, you did share a good history about bear market. Perhaps another things that I think rather unknown or rather lack of history is this Federal Reserve quantitative tightening, right? So they Fed have actually started tighten their balance sheet on 1st of June. So if you can share with us what are the potential effects of Federal Reserve quantitative tightening to financial market?
Sure, yeah. So maybe if we just recap what this actually means is triggered by the Lehman shock and then again by the Corona pandemic, the Federal Reserve has been buying assets in the market. A range of different assets. At the time of Lehman, some fixed income securities, more recently buying treasuries and other assets as well. And this is a way of injecting liquidity, injecting cash into the financial markets to help prop up asset prices, but also help financial institutions to remain liquid to make sure that everybody can keep trading. And this has been done obviously by the Fed, but also by most central banks around the world. And the scale of it is really, really huge. So if you look at the size of the balance sheet, so the amount of assets sitting on the Federal Reserve's balance sheet, before Lehman, they were sitting at maybe about $1 trillion. As of right now, just before they started tightening, they were up to $9 trillion, which is a huge amount of money. If you think US GDP is maybe $23, $24 trillion, almost half of the size of GDP is sitting on the Fed's balance sheet. So it's a large amount of money. And as you said, the Fed has now moved to a tightening phase where they won't be aggressively selling those assets, but as they mature, they'll be letting them roll over and not replace them on the balance sheet. And so gradually, most of those assets are fixed income securities. So gradually, as they mature, the Fed's balance sheet will shrink. What's the effect of that? Well, it's gradually taking liquidity out of the market. And so that is linked to higher levels of volatility, less cash kind of moving around the markets, and so larger asset price movements. More generally, you can think of it as this is more like a return to normality. Central banks have been so active in financial markets for such a long time that it feels normal. But we have to remember that this is not normal. Normally, central banks don't intervene in financial markets to this extent. And so, in a sense, the Fed tightening, allowing its balance sheet to gradually shrink, is a sign that the Fed believes it's safe to return to normality. And that's a good thing. That's a good thing. What it means, I think, is better pricing of risk in markets and better diversification in markets. We've seen certainly year to date a lot of fixed income and equity prices moving together because of activity by the Fed. But as central banks become less active in the financial markets, they become less of a driver of global asset prices. And so we should see a return to more variation in asset returns, both between different asset classes, but also between countries and different markets as well. And that's a good thing for investor diversification, I think.
Yeah. So, well, interesting when you said return to normality of for the financial market, right? So, I suppose investors are so used to the QE environment, where now it's actually not normal, for us to experience this volatile, highly volatile market. Would you be able to share with us how should investors think about their investment during volatile markets?
Sure. Yeah, I think that's a very good question. How should you react to markets where even though perhaps the movements themselves are not out of the ordinary, but they are large. So how should you react? I mean, the first thing to do, obviously, is not to overreact, not to panic. And so really the last thing you should be doing right now is, as a result of the market falling 20%, going out and selling everything and saying, that's it, I'm going to get out of the market. Unless you have a real reason why you need cash right now, it doesn't make sense to sell now that the market has fallen. So, I mean, that's an obvious thing to say, but it's a very natural reaction. You see, the market is down 20%. It's a very natural reaction to think, wow, I don't want to take any more of this. I'm out of here. A very natural kind of human reaction. But as you can see from this kind of graph, it gives you a terrible risk of missing out on the rebound. And equity markets will rebound at some point. We don't know when, and nobody knows when, but it's extremely likely that at some point they will rebound and rebound strongly. Unless you can get it back in quickly, then you're running the risk of missing a large part of this kind of rebound. So don't panic, and don't sell everything simply because the prices have fallen. So that's the big thing. The second point is, take a long run view. If you can think of your investment horizon in terms of years, 5 years, 10 years, perhaps if you're saving for retirement longer than that, 20 years, then on that kind of investment horizon, the kind of volatility we're seeing right now really doesn't matter at all. We saw that long run MSCI ACWI, that global equity graph earlier on. And certainly there's ups and downs, quite large ups and downs along the way, but over a long horizon, it's very unlikely that over say like a 10-year horizon or a 20-year horizon that you're going to see negative returns from the overall equity market. In any 1 year, yes, certainly you can get negative returns, but the longer your investment horizon is, the more likely that this gradual average return of 8-9% is going to be driving your returns. The other things, obviously, are things to do with diversification. Nobody really knows, which market is going to perform best over the next 12 months or so, the best thing you can do is to keep your assets diversified across a range of different countries, a range of different currencies, and a range of different asset classes. And then finally, people tend to forget about kind of rebalancing their portfolio. You know, a lot of people decide on a target asset allocation, and then go ahead and build a portfolio like that. But especially if the markets are moving a lot, then it's very easy for your portfolio to drift away from the target allocation. And you can end up with something very different from what you were expecting. And so the other thing I would say in this kind of market is to make sure your portfolio is kept up to date, is rebalanced, and put back to the target that you have.
Sure. Thanks for sharing the tips for our investors. So I totally agree. We shouldn't overreact. We shouldn't panic. We shouldn't sell everything now. It's a bad time to sell at the discount that we're seeing in the share prices. And we should also take a long-term view. The chances of positive return will certainly favor investors. And it's important to diversify. And it's also important to rebalance our portfolio so that it's aligned with our risk profile. So let's perhaps go to the question from the audience. So there's this question. In your opinion, any reason why gold price didn't rise during the wartime as inflation hedge?
Sure, yeah. Well, thank you. I mean, that's a very good question. So if we think a little bit about, like, you know, what gold is as an asset, maybe that'll help. So gold is a very unusual asset, very unusual financial asset from the point of view of it doesn't intrinsically earn any return. It doesn't generate any income per se. It doesn't generate a dividend. It doesn't generate interest. It doesn't earn any intrinsic income itself. Whereas, you know, a company, it gives you a share of the profits. A bond gives you access to interest payments, things like that. Gold doesn't do that. It's very much like that. Then the other point of view, you know, gold has a range of uses. It does have some industrial uses. It has uses obviously in jewelry and things like that, as well as being this kind of risk hedge. And I think perhaps the question is getting at that. Why, given an uptick in geopolitical risk and an uptick in inflation, why hasn't gold reacted more? And I think the answer here is the idea that gold is a very good inflation hedge is perhaps not correct. Gold is really a hedge against catastrophe. It's a hedge against a breakdown in the global financial system. Because, you know, if everything goes to ruin, if you can still have, you know, perhaps all of the kind of value of your paper assets could go to zero if the financial markets completely freeze up. But if you have access to gold, the idea goes, you know, if you have access to physical gold, then you can still continue buying even if paper money is no use or that kind of thing. So really it's wrong to think of gold as a pure hedge for inflation. Gold is a hedge against a global financial crisis.
Right.
And right now there's no sign of that. There's geopolitical risk, certainly. And there's risks that geopolitical instability in Ukraine could spread or things like that. That's very true. But nobody's talking about a global financial crisis. And I think that's the reason why gold really hasn't reacted much.
Right. Okay, great. Okay, so second question, is it a good time to invest in ETF with some leverage like SQQQ? SQQQ is basically the leverage inverse strategy on this NASDAQ.
Wow.
Right. Yes.
Yeah, sure. So that's a very good question. Yes. So I think everyone's aware there are leveraged versions of ETFs out there, both bull leverage, where you earn basically you say twice the return of the underlying index, or bear leverage, where you earn the opposite of the index or 2 times the opposite of the index, that kind of thing. Just to mention how these ETFs work, they work by holding a portfolio of futures, futures contracts. And so in the case of, say, a 2 times bull ETF, they own futures equal to twice the value of the ETF. And for a bull ETF, they're long futures, and for a bear ETF, they are short futures. So that's the kind of the mechanism how these things work. A couple of things to say on them is they are highly risky. They're using leverage either on the upside or the downside. They are highly risky ETFs. The other point to make is they're expensive. If you look at the management fees on leveraged ETFs, obviously it depends on the provider and it depends on the underlying index, but it's not unusual to see 80, 90 basis points of management fee on these. And when you consider that all these ETFs are doing is holding futures, that's a very high fee for holding futures. They're not doing anything special in that sense. So these are highly risky ETFs, and they're also highly expensive ETFs if you think about holding them for a longer term. So in general, they're not ETFs that I would recommend holding as kind of a core part of your portfolio. They're very risky, and they have a high management fee. Perhaps the question is more to do with short-term timing, whether these ETFs are useful right now. Certainly, that's where most people would use them in terms of a short-term timing point of view. And from that point of view, they can be a useful way for somebody who wants to short the market to go short the market. What I would say, of course, is that that is trying to time the equity market, and that's an extremely difficult thing to do. Partly, as you can see from this graph here, if you're short the market and you get it wrong, unless you get out very quickly, it can be very painful very, very quickly. And so if that's something that you want to do, then and you plan to do it on a relatively short horizon, then those kind of ETFs can be useful. There's nothing wrong with using them from that point of view, but you should be aware that they're highly risky, and you are paying a large fee for the use of those ETFs. Sure,
thanks. Okay, so let's perhaps if we just go back to our question. Well, this webinar is about whether Robo-Advisor can help, in obviously investor to navigate market volatility. So we have seen the rise of Robo-Advisor or automated portfolio based on investor preference, which could be timely as benefit are valuable to investor during this type of market environment, right? Especially when market conditions become uncertain. So Matt, how can a Robo-Advisor potentially help investor during period of market volatility?
Okay, I think this is a fair question. I mean, if we think about what I just talked about in terms of what an investor should do in a volatile market, don't panic, take a long-term view, diversify, and keep your portfolio up to date, rebalance. These are all things that are extremely easy to do via a Robo-Advisor. It's essentially what a Robo-Advisor is set up to do. So if we think about how MYTHEO works, I think everyone's aware. So it's a very simple kind of setup. You answer a few questions in terms of your investment horizon, and based on that, MYTHEO will generate a recommended portfolio for you, spread across growth, income, inflation hedge, so spread across equities, fixed income, and commodities. And then MYTHEO will automatically build that portfolio for you, maintain it, keep it up to date. And so this helps with all of those 4 points here. Not panicking. Well, the fact that this portfolio runs automatically, it's not driven by any kind of individual market view or individual sense of where the market is going from here, how we should be positioned. These are driven off investment models. So it takes away a lot of the bias and human emotion out of investing. And that's a very good way in terms of dealing with a volatile market like that. It guarantees that you won't panic. MYTHEO won't panic in this kind of market. From terms of taking a long-term view, that's exactly how this portfolio is set up. All of these portfolios are designed to generate returns over the longer horizon. None of these are trying to time the market, get in and out of particular asset classes or things like that. These are all long-term portfolios, so it helps there. It helps with diversification. We can see it down the bottom there that MYTHEO invests in nearly 60 different ETFs, countries all over the globe, a huge range of different asset classes. And because it's investing in ETFs, within those 60 or 59, 60 ETFs, there's thousands and thousands of individual companies held by those ETFs. So it naturally gives you extremely well diversified portfolio. It means that the risk of any particular country or any particular asset or any particular company damaging your portfolio is very low. So it automatically gives you very strong diversification.
Sure.
And then rebalancing, MYTHEO will give you this automatic allocation, target allocation across these 3 portfolios. And then every month, automatically, without the user having to do anything, MYTHEO will rebalance you back to the target portfolio. Ensure that no matter how much the market moves and drifts you away from this target, you'll always get back to it automatically. And so I think not just MYTHEO, but robo-advisors in general have a lot to offer in markets that are as volatile as this, I think.
Yeah. So by giving investor a highly personalized and highly diversified portfolio, as well as taking the emotion out of investing, and also rebalance and re-optimize the portfolio back to match the financial goal and risk tolerance of the investors. So this help to navigate market volatility and uncertainties that we are seeing today. So returning back to our the question from our audience, so we're talking about rate cut just now, right, Matt? They potentially could be a rate hike. Sorry, there could potentially be a rate hike this tonight. But question, if let's say we talk about 2030, early 2023, sorry, early 2023, would there be a possibility of a rate cut in year 2023?
Well, there is a possibility. Let's think about kind of what kind of scenario could generate that. So the most likely scenario where you could see potentially a rate cut would be an extremely sharp slowdown in the US economy. And so that would mean a very sharp slowdown in growth, inflation falling extremely sharply, and probably most sensitive would be a sharp increase in unemployment, worsening employment conditions. If we saw that,
right?
If we saw that, and I have to emphasize that there's no indication of that at the moment, then it's certainly possible that the Fed could shift to rates cuts potentially next year. But I don't think, I'm not aware of any kind of major set of economists who are predicting that as a likely outcome.
Right.
So it's certainly a possibility that's out there. I think it's a low probability, unless there's some large external shock, that we simply can't predict. I think it's hard to think outside of a large external shock. It's hard to think of a reasonable scenario where the Fed would be back to cutting rates as early as next year.
Sure. Okay, so question on the will MYTHEO create a portfolio, super high risk portfolio? Wow, super high risk portfolio, which include cryptocurrency exposure. Oh, that's super high.
That's a good question. I can't speak specifically about cryptocurrency, but when we think about potential enhancements or longer term enhancements to MYTHEO, one option that we could look at is this concept of satellite portfolios. And this is a concept that's used by a lot of institutional investors. You have a core portfolio that accounts for, say, 80% of your assets. That's perhaps, for example, based on this MYTHEO allocation. And then you have one or more satellite portfolios that make up the rest of your portfolio. And these might be more targeted, maybe perhaps like thematic, or as the question says, higher risk, higher beta portfolios, or they could be something else as well. Perhaps something a different kind of portfolio in there. That's a sensible kind of approach, I think. With kind of core plus satellites. It gives people, a stable base to their portfolio, but also the opportunity to perhaps seek additional returns from some of these satellite portfolios. That's something that certainly I think we are starting to look at for MYTHEO, and it's we have one way of thinking of a satellite portfolio in terms of our ESG portfolio. We could perhaps add to those portfolios, and the user could decide how much to allocate to the core and how much to allocate to the satellite. I think cryptocurrency is an asset that's still pretty young, and you're getting with ETFs that invest into cryptocurrency. The underlying schemes can be quite complex in terms of how they get exposure to the cryptocurrencies. And also when you look into them, they are expensive in terms of the fees that are charged by and so my personal view would be, before you want to use those as a kind of a mainstream investment tool, you'd want to see perhaps some simpler schemes, and to be honest, some lower fees in there, because if you want to hold this as a long-term element in your portfolio, paying 1% in management fees is very painful in the long run.
Certainly. So, question on China ETF. Any idea whether MYTHEO is going to increase allocation to China ETF during the next quarter?
Yes. So where do we have China exposure? Well, we have China exposure in the growth portfolio. So we do have an ETF in there that's focused on China. It's a large cap China exposure. It's not tailored to any particular sector or any particular part of China, but it's part of the growth portfolio. All of those decisions on how much to hold are driven by the model itself. There's no human override. I don't decide how much is allocated to any particular market or anything like that. So I can't say, whether it's likely to increase or decrease allocation to China. What I can say is, the growth portfolio aims to get exposure to global equities with the lowest possible amount of risk. Because risk is predictable. Returns are very difficult to predict, but risk is predictable. And so it aims to build a portfolio that's nicely diversified and has the lowest amount of risk, given that it's investing in an asset like equities. And so if Chinese equities are seen as relatively lower risk in terms of their realized risk, and we saw earlier on this in the first slide, Chinese equities have certainly been less volatile than, for example, US equities year to date. It's certainly possible that as a result of that, the algorithm might increase its allocation to China gradually over the future. But I can't say for sure that that's going to be the outcome.
Yeah. So we still have exposure to China. It's just that we won't probably know until then that whether the exposure will increase or decrease based on the algorithm. Okay, so the last question I saw here is it a good idea to invest in commodities now since the price is so high? And if the commodities prices stabilize and back to normal, how can Robo-Advisor help to manage it?
Yeah, that's a good question. So we saw that, year to date, a large number, especially of energy and agricultural commodities, are in positive territory. And there is an argument that, they've probably run as far as they can right now, and so certainly on the kind of the energy side. We don't have a particular view on which way commodities are going. I think commodities do have a good role to play in any investor's portfolio, I think. If you think about, the underlying source of the returns of commodities is very different from the underlying returns. There's a return source of bonds and equities. So in the case of equities, it all comes down to the profits generated by the companies. In the case of bonds, it comes down to the risk that you're taking in terms of interest rates, credit risk. The returns from commodities come down to in the long run, the price increases of the underlying commodity itself. So that comes down to global demand, global economic growth. So that's a very different driver of returns than the other asset classes. I can't say, whether commodity prices are at a peak right now. Who knows? There could be another leg up on energy prices. Who knows? But what I can say is, the source of returns of commodities is very diversifying compared to equities and bonds, and that's why they're in the MYTHEO portfolio. You probably wouldn't want to hold 100% in those kind of assets, but I think they have a good place in pretty much any investor's portfolio.
Sure, great. Okay, so let me just launch the final poll. So you have heard the sharing from Matt. Considering the volatility, inflation, and other economic factors, do you expect to increase, reduce, or maintain your investment in the next 3 months? Okay, let me share the result. Well, none of you have said that you're going to reduce your investment. That's good news.
Interesting.
Right. So you either maintain or increase your investment. Most of you are saying that. So Matt, if you can help me to flip to the last slide, the key takeaway. Yep. So let me just wrap up the session tonight. So thanks, Matt, for sharing. Market volatility is inevitable, and is the nature of market to move up and down over the short term. So trying to time the market is extremely difficult. And one of the most important thing to do as an investor is to get invested in a way that is appropriate with your long-term goal and risk profile. And remember to stay invested and diversify and ignore the short-term market noise. Robo-Advisor can help to take the emotion out of investing. When the market swings, so do our emotions. However, using advanced algorithm, Robo-Advisor can help you stay disciplined and automatically rebalance your portfolio to account for these swings. And MYTHEO artificial intelligence will automatically rebalance and re-optimize the portfolio regularly to ensure that it still matches your financial goal and risk tolerance. So with us handling the A to Z of investing, you just need to sit back and relax. So we have run out of time. So thank you everyone for your participation and for attending the webinar tonight. And thanks, Matt, for sharing with us your insight. And we look forward to see you guys again in the next webinar next month. So have a good evening and stay tuned with us. Thank you.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. MYTHEO is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, MYTHEO will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way MYTHEO optimizes your portfolio. The algorithm that drives MYTHEO's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision making. With MYTHEO, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What MYTHEO does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, MYTHEO's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.